there was a glimmer of spread widenings, and then it quickly snapped back to normal. But amid all of that, there's this hope that deal activity is here and that this is a sign it's back and it's going to be back in full force. Is that what you see going forward?
Well, if we look at a couple of statistics, M&A is up year over year, roughly 19%. And that is still way off the averages over the last 5 years, right? So that's a good dynamic. It's up. And within that dynamic, you see some real outliers, like a TMT is up almost 80%, FIG's up 45%, and then industrials, CME, and CRG are up sort of in the 30s. Really good technicals, but they're off a very, very low base. I think, what is exciting for us at Goldman, because we have a great lens into the M&A market, being number one in that market, is we have something called conflict checks, which is the number of firms, private equity firms, that are calling into us to ask, can you work with us? And we see that ticking up, which is just a nice barometer. And then I would say the number of sell-side processes that we have launched in the last few months is up. And in addition, we see corporates being much more active. One statistic we keep an eye on is what we call corporate reclassifications, or selling of divisions, or deconsolidations, and that is up year over year as well. So I think we feel like there's a setup, and I heard the panelist right before us saying that he's also cautiously optimistic. Yeah. Now, will a tremendous amount of M&A buyer to seller get done because they meet in the middle on value? Maybe not. But for the credit markets, you still have a lot of options, whether it's a recap, a minority sale, and that's what we're seeing. So it may not be asset sale outright, but a transaction is going to occur. Take private activity is up demonstrably. Year to date, we're at $195 billion versus last year, I think $125 billion. It's the second highest year since we've been keeping an eye on what we call P2Ps. And that's super interesting. I mean, those are deals that historically have been really hard to get done, but there's efficiency in markets. You see a market value of your equity trading, and so you throw a premium on that, and you can look at the 52-week history of the stock price, and the board can get their head around, and a firm like Goldman can write a fairness opinion. The challenge that we have in private equity is we have this thing called, where are you valuing, where are you marking your portfolio to market? And there's been a lot of discussions about that. But if a portfolio is marked, I'll use an example recently of one I know in particular, marked at 22 times EBITDA, and the bid comes in at 14 times EBITDA, even though it's a very full and fair bid, the PE firm may say, you know what, I'm just going to kick the can. Yeah. I'm going to wait and hope, right? Yeah. But that's why I think the really interesting dynamic right now is the activity around take privates, both in Europe and the US. It's pretty extraordinary.